Collateralized mortgage obligations, or CMOs, are debt instruments that are issued using a pool of mortgages for collateral where the issuer retains the ownership of the mortgage pool and issues the bonds as debt against it. So, for example, you can see in this particular CMO, we've got $75 million worth of mortgages. And against those mortgages, we've applied three classes of bonds, Class A, Class B, and Class Z, with different maturities and different coupon rates that result in different issue values, for a lack of a better term. And so the weight of the Class A bonds is 37.5%, Class B is 20.8%, and Class Z is 41.7%. And so that gives us a weighted average coupon based on the coupon rates of those individual bonds and the weights of those bonds in the CMO overall. So the Class A investors would be thrifts and commercial banks, so the bigger players in the markets. Class B would be insurance companies and pension funds. And then Class Z would be kind of similar to Class B. Class Z is similar to Class B, but as you can see, each class gets a slightly higher coupon rate. So how does this work in terms of producing cash flow? So let's assume that payments into the pool from the mortgage borrowers, those are the borrowers of those mortgages that are collateralizing this security. So let's assume that those payments occur annually and that there's no reinvestment of interim cash flows between the receipt of the mortgage payments into the pool and payment to the various tranches of securities. And the rate of prepayment is 0%. So we're just going to assume that away. So now if we look at the 10 years of payment, so we have 11 years total, with period 0 being when this security is issued. And again, we've got that 10-year term, 11% fixed rate. And so you see the mortgage pool declining over time, but based on our assumptions, the payments into the pool are going to be fixed each year. And so you can see how those fixed payments are divided between principal and interest. So principal in column 3 and interest in column 4, leaving the remaining balance in column 5. So by placing a priority on the distribution of cash flows to various classes of security owners, that was that Class A, Class B, Class Z, and so on, the CMO generally provides more predictability with respect to expected maturity periods and cash flows than a mortgage pass-through. So it's important to try to distinguish between all of these different types of alternative financing, real estate financing options. So we talked about the mortgage pay-through, and so here's the difference between that and the CMO. CMO securities should provide a yield in excess of U.S. Treasury securities because we're taking on more risk with equivalent maturity classes because of that cash flow uncertainty or risk. So CMO prices will vary with both changes in interest rates and prepayment rates. So remember, in that first example, we assumed away prepayment, but prepayment is going to be a significant risk factor for all of these securities. So up to 20 different CMO tranches may be used to create many different security types from a single mortgage pool. So issuers may use a sinking fund structure to redeem the security's principal balance. So one way to do that is with a planned amortization class tranche, so a PAC, planned amortization class, and that offers the greatest degree of cash flow certainty by receiving fixed payments of a predetermined period under a range of prepayment scenarios. Or we could use a targeted amortization class, or a TAC tranche, and that corresponds to a single targeted prepayment speed. Class Z tranches provide for the unpaid coupon to be added to the outstanding principal balance. So one caveat with these CMOs is that during the early to mid-2000s, lenders made loans to subprime borrowers who had poor credit ratings. So we consider a subprime borrower someone who has been issued a subprime mortgage. And so many subprime borrowers had adjustable rate mortgages with a teaser rate, and then when rates rose, they couldn't afford the payments. Securities backed by these subprime mortgages were not Ginnie Mae guaranteed. And so as borrowers began to default on those subprime mortgages, the lower rated CMO tranches started to lose value. So many of the lower rated CMO securities were used as collateral for the creation of CDOs.